Hey guys, it's Dave. I'm going to do another video for you, this time focusing on real estate and talking about whether or not we're out of the woods when it comes to a real estate crash coming. We have seen things normalize, but I'm still seeing headlines, tweets, YouTube videos really spreading fear, uncertainty, and doubt when it comes to a housing crash. There's no doubt we had a run up in prices that is very bubble like, but I want to show you with receipts that housing usually holds up pretty well in an economic downturn. We have this curse of only knowing what the last crash was and having that fresh in our minds and thinking that it's going to happen again. That's not what always happens in an economic downturn. In fact, it's quite the anomaly, the Great Recession that we had and the foreclosure crisis, the housing crisis, whatever you want to call it. Let's do a quick chart showing how activity is currently. This is the median sales price for all metros. We're only 2% down from last year. So we had this runoff at the end and we're almost back up to last year's highs. Traffic is really down, but prices have held up pretty well. And I want to kind of bring up this article that talks about kind of the unicorn years that we had with COVID. This is like some showing data information from Showing Time. And it basically is an index they use to see what kind of traffic you have on scheduling showings for real estate. And you can see the purple or the pink columns there where we had two spikes during the COVID years, and it's come down, but it's still higher than we had pre-COVID. So still showing traffic that's more than normal, but it feels like it's a lot lower than in previous years. And so this is like the home appreciation during the unicorn years that they're calling it, where we had a spike of 11 and 18%, and then we're kind of normalizing down to maybe a 5% increase in home prices. And I'll show you a different way to look at that in just a minute. But here is like the foreclosures that typically happen prior to COVID. We're obviously seeing that come up because there was a moratorium during COVID. And so there is some foreclosures that are going to be coming up, but that doesn't mean we're going back to the 2008 levels. Not really at all. So I just want to kind of like put a calming message out that this might end up being a soft landing for real estate, and it might just be a normalization where we don't see, pricing wars. We see a 30 or 60 or a 90 days on market, which is very normal. We had interest rates, hit the 7% range here recently. Historically in the last decade, that's pretty high, but I can show you that hasn't always been the case, and the market has done really well in times that we've had that. So this is the home price index going back to the 80s. And I'm going to zoom in because it's hard to see the recessions that are grayed out on this. These columns here that you can barely see are recessions. And we had one in 80. It's kind of a double dip recession where we briefly came out of it in 81 and then back into it in 82. This line is housing prices. And you can see that during this recession, housing still actually managed to come up. And interest rates in this period, and again in 82, 83, you're talking 10 plus, some up to 17% interest rates for mortgages. Granted, the home prices were a lot lower, but it's still relative when your income is a lot lower at that time. So just because we have high interest rates, just because we have a drop in traffic or potentially an economic recession or a slow in GDP, that doesn't mean that housing prices have to crash. Evidenced here, evidenced here. Fast forward to 1991. Here's the recession. Prices flat. Fast forward to after the dot-com. Here's the recession. prices are actually going up. Now you can see we start to build and peak here in home prices. This would be 2007 here. Here's your recession, your official recession, 2008 and beyond. And this is the one that's fresh in everybody's mind. And we think that because we have a bubble, it has to pop. It can't just bleed out slowly, and it has to be painful. Housing may end up being okay during this economic cycle. We definitely had a peak coming up here. This was the crash that everybody has talked about. Look at how big of a dip housing prices have gone in the whole scheme of things. It's not as bad as people make it seem. That doesn't mean it won't get worse, but it hasn't happened yet. And it's actually showing some signs of life. That's a little bit of a turn back up at the end of that. So what I want to also show you what has happened during this time, and probably the main reason that you're seeing that this being different than previous years, is what we had with the pandemic creating different demands in supply, or different spikes in demand, and then a withdrawing in supply. So you had people flowing to the suburbs from the city core because the pandemic allowed people to work remotely. It changed the way the downtown corridors looked. You had people even leaving different states because they can work remotely. And we also had the building had to stop for a short period of time. I remember helping someone do new construction in 2020, and it's 6 months to get a garage door. We had to close on the house with temporary garage doors in because the ones they ordered at the very beginning of construction still weren't in. And I talked to him actually 3 months after we closed on that, and he had just barely got his official garage doors in. So you have the supply side constraints with the pandemic really slowing construction down, and you have a peak in demand because of stimulus, because of low interest rates, because people wanting to get out of city corridors or just shuffle around now that their job outlooks have changed. That's way different than what we had in 2008, where we had loose credit. We had, you know, the fix or flip craze was just coming on TV, and everybody thought they could make a quick buck flipping houses. And then this chart will show you just kind of what we were doing as far as building goes. And I've shown this before, but it really bears repeating. Here's the drop that you can see. And again, I'll zoom in because the recessions are hard to see. Here's the recession. Here's another one. And then these lines here, I'll zoom back out. This is 1.2 million single family home line. And this would be the 1 million single family home line. So if we're looking at historically how things happen, here is a decline in home building and then a recession right after it. We had a decline here, but avoided recession. Here's a decline in home building, recession. Here's a decline in home building with a recession. This is now 1974. Here's a decline. This is that same double dip recession area, where you're getting a big decline overall, a spike back up and a decline in this recession area. But then the whole 80s, this is the 1 million housing line. Through most of the 80s, we're above 1 million homes built. This is single family homes. And then we have a decline followed by a recession here. We go back up, and now you could argue we're at the 1.2 million for most of the 90s, before a quick little recession for the dot-com bust, and then we're off to the races in building here. This is where you have a high amount of supply, you have loose credit, this causes the bubble for this one, then you have a drop. You have a lot of builders go out of business during this time, and then they are super reluctant to build for a full decade. Here's the 1 million mark and the 1.2 million mark that I spoke about previously. And you can see we don't even barely touch that until right around the pandemic, and then we're back down below it. So this undersupply that's led up to the peak that we've had is why I don't feel like housing is going to experience the same crash that it did in 2008. There's just not enough homes to go around. This is what our population has done going back to the 80s. There's no dips, there's no spikes. It's steadily growing and growing and growing and growing. And so when we have housing starts that during this time go like this and then do that, we have undersupply. We also don't have the rush of foreclosures because of that loose credit. Here is a chart showing how foreclosures have behaved over that timeline. This actually goes to 2013 here. And you can see we're way below that, a little bit of a peak. This is actually 30-day late plus foreclosure. So that's why during the pandemic, you actually see that go up. If it was just foreclosures, it would look like that. It goes like that for a foreclosure chart. But this is also tracking people that are delinquent. And I threw that in there just to show you that even with throwing in delinquencies, it's nowhere near what it was back during the last Great Depression. So, I just think it's different this time. I think that there's, a lot of different variables that the pandemic has caused, an underbuilding because of skittish builders, and then we just don't have the loose credit. And I'm just tired of seeing everybody preach fear, because that's what sells, that's what gets you to click, that's what makes everybody scared. They're building more multifamily these days than they are single family. And so we may run the risk of being a renter nation if people are going to stay on the sidelines and not get in the game. So last thing I'll say is bringing it back to the normalizing that I think we're doing. This shows kind of the way that we do showings. And it tracks back to 2014, not the way we do showings, but the activity in showings. This is an index put on by Showing Time, and I mentioned it earlier in this video, but I want you to kind of see the way cycles normally happen in this. We have, we peak in the spring and then we taper off until the winter. And then we peak in the spring and taper off during the winter. And then we've been building slightly higher highs and lower lows until we have a pandemic hit. This is 2020 here. You'll see that we peaked in spring, then we get locked out. That's what this little drop is. So it would probably look more like that if it weren't for the lockdowns. But because of the increase in demand and the low interest rates, look at how much traffic jumps the following two unicorn years. And so even though we had a big crash in traffic after the rates went away and we're now paying 6-7% for it, we're still, even at this low this winter, is still a higher low than the pre-pandemic levels. So real estate's not dead. Prices are holding in pretty well. You're going to see people start talking about Austin is in a recession and crashing, and Boise and Las Vegas. And we've seen a spike in inventory there and a drop in prices. That will be the case when things got too hot. You will see bubbles break. But as a market overall, I feel like we're just kind of slowly letting the air out at this point. And unless we lose a lot of jobs, and I mean a lot of jobs, I don't see the crash that everybody is preaching about. And hopefully there's some data here to kind of support that. It hasn't happened yet. It doesn't mean it won't happen, but there's a lot different this time around than the last time. And in fact, if you look at historically, the last time was more of an anomaly than a regular occurrence when we have a bad economic cycle. Hopefully this economic cycle that we're in is going to be just more of your typical run-of-the-mill recessions, maybe some dips in categories here and there. Certainly office real estate is going to have a day of reckoning and get revitalized and reinvented with office space. But I think that we can contain that, and it might not spill over into just the regular single family housing. Why don't you like this video if you do like it, and then subscribe to the channel so that you can see more content like this. My name is Dave McGuire. I appreciate you watching. Thanks a lot and have a good day.